All right, let's dive right into this explainer and explore a moment the financial world has literally been anticipating for decades: the monumental 2026 transition at Berkshire Hathaway. The legendary architect has finally stepped aside, and the blueprint for what comes next, well, it is absolutely fascinating. It's basically the ultimate corporate stress test, right? Warren Buffett is stepping back at age 95, leaving us with this massive trillion-dollar question. How do you transition an empire built on the unique genius of one single man into a modernized corporate machine without losing its soul? Let's look at the data to see exactly how they're pulling it off. So, here is our blueprint for the new fortress. 1. The post-Buffett era. 2. The Fantastic Four. 3. Margin expansion. 4. The $373 billion treasury. 5. Pivoting the portfolio. And 6. The modernized fortress. Let's get into it.
Part 1. The post-Buffett era, a change in style.
On January 1st, 2026, Gregory Abel officially took the reins, and wow, you can literally feel the shift in the air. We are moving away from Buffett's classic, folksy, investment-led approach, where he essentially just trusted managers and left them completely alone. Abel is a different animal. He's an operator, straight from the gritty energy sector. He's clinical. He still allows autonomy, sure, but under his watch, that autonomy must be grounded in deserved trust. He is actually getting under the hood and demanding real performance. The era of the friendly handshake is officially making room for the era of the spreadsheet. Okay, part 2. Meet the Fantastic Four, distributing the legacy. To manage this huge vibe shift, Abel is moving away from that one-man show we're so used to seeing on the annual meeting stage. Instead, he's bringing in a Fantastic Four leadership bench. Now, you still have Ajit Jain masterminding the massive insurance engine, obviously. But look at this. We're seeing real operational heavyweights stepping into the spotlight. Katie Farmer is relentlessly tackling capital efficiency over at BNSF Railway, and Adam Johnson is scaling NetJets into a high-margin crown jewel. It just goes to show, Berkshire isn't just a stock portfolio anymore, it's a living ecosystem of incredibly well-run operating businesses.
Moving right along, Part 3. The margin expansion mandate, the pursuit of 1%.
Here's the thing. When you are as gigantic as Berkshire, finding companies to buy that actually move the needle, it's practically impossible. So a Munger is looking inward. And it all boils down to this absolutely wild number: $230 million. That is the exact amount of incremental cash flow generated by just a single, tiny 1% margin improvement across their businesses. Just 1%. It really is the defining insight of the 2026 era. Because of that, Abel is turning all 51 non-insurance divisions into relentless compounding vehicles. Think about BNSF, for example. The playbook is simple but intense. Establish the baseline operational performance, target very specific gaps, like fuel efficiency compared to their peers, and then enforce super strict accountability metrics. Actually, it's not glamorous at all, but man, it is exactly how you squeeze hundreds of millions in hidden value out of the assets you already own to keep compounding wealth over the long haul.
All right, Part 4. The $373 billion treasury, the ultimate defensive hedge.
Listen, if you only take one single thing away from this explainer, let it be the sheer mind-boggling scale of Berkshire's defensive posture right now. For the absolute first time in their history, their cash pile has officially eclipsed their entire public equity portfolio. No way, right? At the start of 2026, they are sitting on over $373 billion in cash and T-bills, compared to $320 billion in public stocks. To put that into perspective for a second, they literally hold more cash than the GDP of entire nations. With the broader market looking pretty expensive, Abel is perfectly happy to just sit back, earn a steady yield, and wait. And you know, this massive, seemingly boring treasury is entirely by design. It makes Berkshire the ultimate buyer of last resort. Think about it. If the market suddenly tanks 30% tomorrow, Berkshire doesn't panic. They feast. They go shopping. Honestly, that is the core thesis for owning the stock in 2026. It offers a level of capital preservation and defensive anchoring that you literally cannot find anywhere else in the modern market. Which brings us to Part 5, Pivoting the Portfolio, a new strategic direction. So what about the investments they actually already hold? Even with Buffett still around, offering that high-level judgment, Greg Abel is actively shifting the chess pieces.
Now, the portfolio remains incredibly concentrated. It's anchored by just four massive pillars: Apple, American Express, Bank of America, and Coca-Cola. They are absolutely not interested in broad diversification. The game plan is massive stakes in deeply understood, super high-quality companies and just letting them compound for decades. However, if you look beneath that stable surface, there's some really aggressive tactical shifts happening. Able severely slashed tech names like Amazon, dropping it by 77%. I mean, that is a glaring signal that a complete exit is imminent. Meanwhile, look at where the capital is actually flowing. A $1.8 billion pivot into Japanese insurance with Tokyo Marine, and a jaw-dropping $9.5 billion acquisition of OxyChem. It's a crystal clear, deliberate pivot away from consumer tech and a hard charge toward global infrastructure, energy, and physical assets.
Finally, Part 6, the modernized fortress, institutionalizing the legacy.
You have to realize, to manage nearly $400 billion in cash and 400,000 employees, that old, small founders shop mentality in Omaha is officially growing up. They've just hired their first ever general counsel, Mike O'Sullivan, and they appointed Chuck Chang as CFO designate just to lock down that massive treasury. But get this, perhaps the biggest flex of all, Greg Abel is taking his entire 2026 after-tax salary and dumping it straight back into Berkshire stock. He is operating as the ultimate chief risk officer right now, drawing a super hard line against unwarranted liabilities and ruthlessly guarding the walls of the castle. It really all comes back to this incredibly powerful sentiment from Abel's 2026 letter. He said, "The castle Warren built is not crumbling, it is evolving. The legacy isn't about just one singular visionary surviving anymore. It's about surviving through a highly disciplined, institutionalized system. Those core old-school principles of value and patience haven't moved an inch. They're just being executed with ruthless, modern operational precision." So as we step back and look at this modernized trillion-dollar fortress, it leaves us with a really provocative question. In an economy that's getting more unpredictable by the day, is radical defensive positioning actually the absolute best way to compound wealth? With a $373 billion war chest, Berkshire Hathaway isn't just prepared for whatever comes next. They are literally banking on it. Well, thank you so much for joining me on this explainer. Keep questioning what the numbers are really telling you, and I'll see you next time.